Today, we will walk through the world of cryptocurrency tax. We will go over the classification, forms and reporting rules. Cryptocurrency white paper for a peer-to-peer electronic cash system was published in 2008. The Bitcoin network was launched in 2009 and quickly evolved into thousands of digital assets powering payments, smart contracts, NFTs, and decentralized finance. As crypto adoption grew, governments needed tax rules to catch up. For U.S. federal tax purposes, digital assets, crypto, NFTs, etc., are treated as property, not currency. That means crypto is taxed like stocks or real estate. Every sale, trade, or disposal triggers a tax event. That means most disposals equal capital gain or loss. Receipts of crypto as payment, mining, airdrop, and staking equal ordinary income. Digital assets are considered property. And tax rules for property apply, meaning keeping track of the cost basis, the holding period, the capital gain or loss on disposition. Here are a listing of events that are generally taxable. Selling crypto for US dollars, also called fiat, will trigger capital gain or loss. Trading one crypto for another, for instance Bitcoin for Ethereum, triggers a taxable disposition of the first asset. And the gain or loss is measured in US dollars. Spending crypto to buy goods or services is treated as a sale. The gain or loss equals the fair market value at time of spending minus basis. Receiving airdrops and hard fork could be a taxable event. A crypto hard fork is a blockchain split, and an airdrop is a distribution of new coins. When a hard fork occurs without an airdrop, there is generally no taxable income. However, airdrops following a hard fork are considered income, taxable at the fair market value of the new coins on the day they are received, provided the user has dominion and control over them. Dominion and control generally means the ability to sell, exchange, or transfer the asset. Staking rewards, mining, or rewards for services result in ordinary income when you receive them, fair market value at receipt. If mining is a trade or business, net proceeds may also be subject to self-employment tax. Revenue Ruling 2023-14 clarifies that for cash method taxpayers, cryptocurrency staking rewards are included in gross income at the time the taxpayer gains dominion and control over the tokens. The following transactions are generally not taxable. Buying crypto with US dollars results in no tax at buy time. And transferring crypto between your own wallets, no change in ownership, it is not a taxable event, but records must be kept. Crypto is taxed as ordinary income, meaning at your regular income tax brackets, when crypto is received as wages, contractor pay, mining rewards, staking rewards, and some airdrops/hard fork receipts. Report those transactions as ordinary income, if self-employed, also consider Schedule C and self-employment tax. Crypto is taxed as capital gains or losses when you sell or otherwise dispose of a capital asset. When crypto is held for less than a year, disposition of the asset is a short-term capital gain or loss. It is taxed as ordinary income at a marginal ordinary rates, from 10% to up to 37%. When crypto is held for more than a year, disposition of the asset is considered a long-term capital gain or loss. It is taxed at preferential long-term capital gains rates, 0%, 15%, or 20% depending on taxable income. High earners may face NIIT net investment income tax of 3.8%. If you received, sold, exchanged, or otherwise disposed of digital assets during the year, you must report the information on Form 1040. All taxable crypto disposals must be listed on Form 8949 and summarized on Schedule D. This includes trades, swaps, and spending crypto on goods or services. Also use the form to reconcile amounts reported by brokers to IRS records. Report crypto earned as income on Schedule 1. If self-employed or in mining business, report on Schedule C, self-employment tax returns, and SE tax apply, where relevant. Treasury and IRS finalized broker reporting rules that require brokers to report digital asset sales and exchanges on a new information return using Form 1099-DA, beginning with transactions on or after January 1, 2025. This is intended to mirror 1099-B reporting for stocks and bonds. Even if you don't receive a 1099 or 1099-DA, you must still report taxable crypto income and gains. The lack of a form does not excuse reporting. For record keeping, you must save at a minimum for each transaction the following: the date and time of acquisition and disposal of the assets, also necessary to prove dominion and control. US dollar value at acquisition and disposal, which help determine the fair market value. The type of receipt such as purchase, trade, airdrop, staking, payment. The transaction fees and exchange fees with basis adjusted and expense treated as appropriate. If used for business, records showing business purpose and expenses. The amount of crypto and transaction IDs, also known as transaction hash. A transaction hash is a unique 64-character alphanumeric identifier assigned to every single cryptocurrency transaction recorded on a blockchain. It acts as a permanent, verifiable, digital receipt and is a fundamental component of blockchain's transparent and immutable ledger system. DeFi actions such as yield farming, liquidity providing, wrapping tokens, and complex swaps usually trigger taxable events. The IRS expects you to track the fair market value at each step. Traditional wash sale rules apply to stocks but not crypto, at least not in 2025. That means you can sell crypto at a loss and repurchase it immediately. Lawmakers have pushed to close this loophole, so chances are, this will get updated. Crypto no longer qualifies for like-kind exchanges. Section 1031 applies only to real estate now. Every crypto swap is fully taxable. Crypto in foreign exchanges may trigger future reporting requirements. The rules are evolving, so keep an eye on IRS and FinCEN announcements. You can reduce tax legally by holding assets for long-term rates, harvesting losses to offset gains, tracking your basis across wallets, and timing large sales in low-income years. Always follow IRS rules. To summarize, good records are essential. Track acquisition date, sale date, value in US dollars, and transaction fees. Exchanges may not capture every detail, especially for DeFi. People often forget that every trade is taxable, staking rewards count as income, and missing one 1099-DA can trigger an IRS letter. Double-check everything before filing. To stay compliant, understand how crypto is taxed, keep thorough records, and report every income and disposal event. With the new 2025 reporting rules, accurate tracking is more important than ever. Thank you. If this information has been valuable and informative to you, please like, share, and subscribe.